Welcome to the Chrisman Commentary Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include making sense of numbers, my interview with Regal Capital's Vijay Marolia on understanding how blockchain technology is seeping its way into mortgage transactions, and after receiving CPI earlier this week, today brings PPI. Thanks to today's podcast sponsor, ICE. ICE has and continues to transform the housing finance and homeownership experience. By seamlessly integrating best-in-class solutions, ICE optimizes every stage of the loan's lifecycle. As the standard for innovation, artificial intelligence, efficiency, and scalability, ICE is the technology of choice for the majority of industry participants, defining the future of homeownership. Learn more at mortgagetech.ice.com. I somehow managed to make it through high school math while only being able to remember even numbers. What are the odds? As the California MBA's Western Secondary breaks up in Southern California, numbers are dancing in everyone's head. Volumes, margins, gain on sale, concessions, and extensions. I even have a numerical riddle that stumped me instead of the usual joke today. Even the solution had me befuddled. But a veteran LO once told me that she always looks at the coffee a potential client is drinking. Who's going to grouse more about an eighth in rate? Someone who makes their own coffee for less than $1 a cup, or someone who buys it every day? At an average of $5.74 per cup, a daily Starbucks latte costs nearly $2,100 a year. Had you placed that amount in a high-yield savings account with a 4% return, you'd end up with almost $2,200 after 1 year, a modest $84 gain. Much larger gains could be realized over time if this money had been invested in equities. Turning to interest rates and a steeper yield curve helping arm production, without any top-tier data yesterday, bonds experienced a little rally. The market movement stemmed from Treasury Secretary Bessent making 2 television appearances arguing for a 50 basis point rate cut in September, followed by continued loosening that would total at least 150 basis points, something markets do eventually expect. Mr. Bessent's comments essentially cemented expectations for a 25 basis point cut at the conclusion of the Fed's next meeting on September 17th. Recent inflation and employment data have shifted the policy conversation toward how aggressively the Fed should cut rates at its next meeting, with some market voices openly considering a 50 basis point move, which is currently priced in at roughly a 4% chance of happening. While political pressure on Fed Chair Powell is nothing new and has historically hardened his resistance, the data now supports a return to normalization, likely through a series of quarter-point cuts rather than one large move. Market pricing via the SOFR curve implies a gradual reduction to around 3% by late 2026, close to the Fed's long-run neutral rate estimate. As a reminder, the upper bound of the current range is 4.5%. For today's interview, I wanted to welcome back to the show Regal Capital's Vijay Marolia to discuss how blockchain technology is seeping its way into mortgage transactions and how to prepare for the shift to a more digital landscape. He's the managing partner and chief investment officer of Regal Capital, a fast-growing multi-strategy investment firm. He has over 20 years of experience in capital markets, specializing in hedging within equities, fixed income, real estate, and derivatives.
Something that a lot of people might be excited about, something that older people in the mortgage might roll their eyes at, and that's Bitcoin, stablecoin, blockchain. I think we just lost a bunch of listeners after I said, no, I'm just kidding. It's something that I, for a while, have championed as a good use case for mortgage, at least in terms of the secondary market and trading loans, having the provenance along the blockchain and being able to verify things without stacks of paperwork and all that. And let's start by setting the stage a little bit. I've had people on before to talk about stable coins and how that could work kind of as a revolving door at the closing table for mortgage transactions. But when it comes to stable coins or blockchain, how would you assess its current place in the mortgage industry rather than where we think it can head? What's happening with it currently?
Well, I think that it is probably still tip of the iceberg, specifically for the mortgage market, although the mortgage market might see down the road some of the fastest adoption. And it's for the reasons that you just highlighted, because nobody wants to go through stacks and stacks of paperwork. And of course, you have some solutions like Adobe and DocuSign and whatnot. But still, I mean, theoretically, the blockchain technology can get rid of just title insurance industry in general. And I'm not saying that because I don't like people that are doing that, or it's not going to happen suddenly. But what we're trying to do is get ahead of the puck, kind of Wayne Gretzky the situation here. But yeah, it's a great solution. So it's really not about whether it's, do you buy Bitcoin or do you buy Ethereum? It's the blockchain technology is genius. And I think that's why it's a good name, the new legislation, the Genius Act, because I think the thing people don't really quite grasp, this is replacing a previous technology. That previous technology is like 500 years old. It's called double entry accounting. The Medici family created it, and man, it really helped them out big time. But let me take a step back. I know I've said a lot there.
Well, I was going to say we have Eric Dickerson speaking at NBA Annual, so maybe it's run to where the ball's going,
Okay.
rather than where the puck's going with Wayne Gretzky. I'll flip it there. I do want to talk about the Genius Act in a minute, but to kind of in layman's terms here, where is the puck heading, or where is the ball going when it comes to this technology? What do you think? And it's probably closer.
Great question.
It's probably closer to being put into everyday practical use in the industry than people think. So where are we headed with it?
So in one word, I would say tokenization. So what is that? Let's kind of unpack that. So I believe that most, if not all, of our significant assets, whether it is something tangible like our automobile or our art and collectibles jewelry, or whether it's something intangible like our intellectual property, our equity, anything that can be converted into a cash flow, a revenue stream, is going to be tokenized. And what that's going to do, that's going to create massive amounts of liquidity, and it's going to allow an opportunity for people that were really shut out and have been shut out. And why? Because they have to invest with lower dollar increments. And what this will do is allow people to invest in assets of all sorts with lower dollar increments, and in a way where they don't have to put the trust in their own government or their own banking institution.
So, and let me interject quickly, and I will say, for a lot of the people in the industry that are in their 50s and 60s and have been around for they might be rolling their eyes at this and thinking, well, what happened with NFTs and that sort of thing, and this will probably go the way of that. What would you say to not ease their fears, but kind of rebut against that?
Sure. So the thing is, evolution does not happen all at once. And so what about this? There was a time when Florida was a new development real estate project. And I'm talking about back when Henry Flagler was building the railroad down here. And there was what? There was a big boom and then a big bust. But here I am in Florida, and I'm telling you, we're rocking and rolling. Sure, there are pockets, especially in residential real estate, that are not really seeing the best days. But the state economy as a whole, business and consumer sentiment in this state versus others as a whole, I mean, we're rocking and rolling. And so what I would tell them is that it takes time, and people were getting carried away with it. And I actually blame the Federal Reserve and that whole the stupid solutions during COVID. We basically said, everybody sit at home and here's a bunch of money. And please don't make any bad decisions. That was idiotic. And so idiotic decisions were made. Just because an asset class has a really sudden rise and then a sudden decrease, it doesn't mean that asset class is going away, right? Maybe tulips are the exception, but I mean, there's still people buying those things too.
Yeah, and maybe I'll rebut here just so my listeners don't think I'm
Sure.
ability, and I'll say I don't know if Florida's rocking and rolling still. Sure, there might be pockets, West Palm or Miami, that are doing well, but as a whole, we've heard stories of how the
Oh,
state,
Central and North Central are killing it.
it's not, it's going better in other parts of the nation, potentially when it comes to home prices and those sorts of things.
Oh
Regardless,
yeah, sure. Residential real estate is the exclusion, so I want to make that point clear. Yes, residential real estate in Florida. I mean, we're hurting. Texas is hurting, but outside of residential real estate, there is a lot of growth. There are a lot of jobs. So yeah, I think we agree on that.
yeah, well, I say this as your friend, because I like you, but kind of tongue in cheek here. This is a residential real estate podcast, so
Fair enough. Fair
yeah,
enough. My
fair
bad,
enough, fair
brother.
enough. Well, let me go this way. We'll be constructive here. The Genius Act is something you mentioned, and you said there's going to be great benefits for these the blockchain or stable coins or those sorts of digital assets. What can you give some background on the act and then why you think it's so beneficial and how it changes things?
Sure. So, and maybe we could start with like an example, because Bitcoin, that's kind of the OG, if you will, and that was the first that demonstrated the power of the blockchain. But once people understood the methodology, and this is the beauty of the evolution of a free market system, when you allow people to take ideas and then build on top of them, right? And so then Ethereum came out, and that I think is going to be the real beneficiary, Robbie, of the new legislation. And the reason why is because what Ethereum will do is it will be the smart contracts. That's what they call them. It's a smart contract. In other words, all those stacks of paper, those contracts, right? The lawyers are making a bunch of money. Everybody's making all this money, but it's wasting time. It's killing trees. It's killing our brain cells and all that stuff. And so the smart contract automates all of it, and it makes it so that it's nearly impossible, if not impossible, for fraudulent activity. And again, that's due to the genius of the blockchain. But I believe that Ethereum or Ether, the price is probably going to continue to increase because there is only so much that can be mined, but the demand, there's like a lot of pent up demand. There's going to be even more demand with the new legislation, not only from people that are trying to tokenize assets that they already have, which is a form of securitization. And maybe I should have, talk about bury the lead. My bad, Rob. So tokenization is like securitization. We've already done this before, except instead of giving so much money to the investment banks and the lawyers, that'll basically bring down the cost of the transaction, and that's really the key.
Yeah, and so I want to make this practical here. For people that are skeptical, sure, you could argue it's a tulip cycle, but Bitcoin, yeah, it's gone up 6x in price over the last 2 years. I think as we're recording this, it sits around or just above $115,000 for a Bitcoin, and we've seen it kind of steadily rise. And some of the volatile kinks have worked themselves out, and it's become more of a stable asset. But in terms of practical adoption for the mortgage industry, how do we get to a point where it turns toward ubiquity and there's greater adoption?
Well, I think legislation is a start, and then what's going to have to happen is we got to see more and more adoption. So before it gets into a standard for the mortgage industry, it needs to become more standard within retail, more standard in investment accounts. So, for example, Fidelity, they are now allowing crypto accounts in their for their customers, and they have probably some of the best distribution right in the country. Of course, the ETFs is a huge source of demand, and that I think we're only on the tip of the iceberg because the stable coins are going to be a big growth area because what it will allow is to take the benefits that Bitcoin and the blockchain provide, but without the volatility, because you're not tying it to the cryptocurrency. You're tying it to whether it's the U.S. dollar or a basket of currency, or commodities, gold, what have you.
And maybe I buried the lead here because you're the chief investment officer at Regal Point Capital, and I'm hoping you can talk about kind of your day to day and why your position allows you to be prescient on topics like this, and just kind of where you see the capital flows happening or going.
I mean, my day to day, I mean, you would probably think I'm a lunatic, but I like read like more than I've been told most people that other people know, certainly more than anyone that I know myself. But I'm also sitting in front of a lot of screens. Now, that's not going to be good for me. I don't recommend you try this at home, but I got the Bloomberg terminal there and a lot of different news. Now, it is good for me because I'm like curious almost to a fault. Um, and I have been diagnosed with, I think they call it ADHD, AF is the new one. So I have that. Thank you for having a sense of humor, Rob. But no, you know what it is? I've been fascinated by money since I was younger because it seemed as if the things that I wanted, my parents would basically have the same excuse. Oh, that's too expensive. That's too expensive. And so in my mind, I was very naive and dumb, young and dumb, as they say. And I was like, man, if I could just figure out this money thing, all my problems will be solved. Of course, that's not true. It's not true at all. But the fascination continues. And then I started to realize that a lot of people didn't really understand it that well. Like there's a lot of people still out there today, smart people, great people that don't know that the dollar is still not backed up by gold, right? I want to promote financial literacy, and I want to make it so people are less scared of not just finances in general, but let's talk about the mortgage market. Debt is a double-edged sword. You could use it as to your advantage, and the wealthiest people do that over time. And so, again, remember the thing I said, I think when we started talking, is when people hear a bland generalization, housing prices will never go down, or the housing market is screwed. So like you're talking about 50 different states with so many different areas, and it's not the same for everyone. And so I really think that people need to be careful where they get their information. And kudos to you and your team for putting out information that is not only easy for people to understand, but it's also actionable. So thank you, Rob.
Yes, although I've been told I'm not a great journalist because I don't always cite sources, and who knows how much fact checking.
Do they even make good journalists anymore? I think they stopped making those years ago.
Maybe over at maybe different publications. No,
I'm
I'm just
kidding.
yeah, me too. But I mean, you've been quoted in Yahoo News. You've been NASDAQ, financial advisor, various sources. So you obviously have some background here. You got a couple decades capital markets experience. What are we seeing in terms of hedge fund or private equity appetite for these type of assets? Because I would say that where the money flows and where there's interest there, I think markets will eventually follow. They're starting to adopt more and more of these strategies. I know you mentioned Fidelity.
Yeah, but also BlackRock, and I mean
Yeah.
they're all lining up. They can't wait. They're basically like watering at the mouth, if you could picture that. I mean, sorry to turn away your appetite.
I'm wondering.
No, it's a great question. In other words, like the institutional involvement, what's happening with that? Can I try to?
Go ahead.
Cool. So first, let's take one step back. If you remember, private equity really got involved after the great financial crisis or the subprime blow up, whatever you want to call it. And really, it's because everybody was starved for yield, right? So the Federal Reserve artificially suppresses rates, and then people are just like, they just need it. And so rents were a really good provider of yield. Here's what's happening now. So that was before. What's happening now? Private equity, now that rates have gone up, they're like, wait a minute, instead of buying the equity on the balance sheet, why don't we just lend the money and then get some sweeteners and then maybe take a ride on the upside? And that way we cut our risk. So what's happening is private equity is turning into private credit. They are competing with the banks. If you look at, so one of my favorite sources of news, and this is actually a partial answer to your previous question. So there are some publications and subscriptions that when I tell people how much they cost, they think that, they think I'm crazy for spending money on it. But what they don't understand is if you take that information, every once in a while, you'll be able to make, multiples of whatever that subscription is. And so there's one called Grant's Interest Rate Observer. Once again, it's Grant's Interest Rate Observer. I think it's grantspub.com. And James Grant, man, he's one of the smartest guys probably in the entire financial world. And if you remember The Big Short and that whole story, the way that a lot of people got that idea, even before the people that were, starring in the movie, they read it in Grant's Interest Rate Observer. So I highly recommend it. He's not paying me, so I don't want you guys to think that there's any kind of conflict. But if you look in there, there's so much great data. And one of the things it showed is that although the Federal Reserve was slowly shrinking its balance sheet, in other words, you would think that that credit is no longer growing. There's another line, ABS, and asset-backed securities, man. It was just exploding. Up until just a couple of months ago, it was growing at 40% year over year. That's 40% year over year. Now that's credit creation, so that also has an inflationary effect. However, these loans are not like your traditional loans, as we know. But I think to answer your question, the private credit is going to be what's going to be in the headlines, at least for the next few years. Now, if rates drastically change, then my opinion could drastically change.
Sure, and I've seen some stuff too. I'm kind of worried about consumer credit. It seems like people are getting tapped out on their credit cards.
God, you are not
instruments.
Well, especially with student loans, right? Not to interrupt you, I'm sorry, but now that people are having to repay their student loans again, we've seen delinquencies go up in auto. We've seen credit card balances continuing to rise. People are asking for more credit. Sorry to interrupt you, Robbie.
No, you're good. And I was going to say that we've seen these things rise, and so that doesn't portend well for the economy or spending, retail spending out there, which could be bad. I've also seen storm clouds on the horizon when it comes to private equity, essentially giving companies credit, much like mortgage companies were extending credit to individuals before the Great Recession. Maybe there's private equity that's extending credit to companies they shouldn't. But let's stay positive here, and I want to close with this just for the sake of.
But you're right. You're 100% right. Yeah, and look, I'm all about the facts. So sometimes if there's a negative fact, we have to bring it up. That's, I think, one of the services that you're providing that I'm trying to also provide.
Cool. Like I said, for the sake of time, let me close with this, and that is whether people believe in this or whether they're skeptical about it. It probably behooves them to at least be prepared or kind of try and ride the wave rather than let it pass them by. What are the best ways that mortgage originators out there, lenders, can prepare for some of the changes that we've outlined in this interview today?
Well, I would probably try to use AI and sources like YouTube and other podcasts to learn more about smart contracts, about tokenization, because then it'll take away the, like the fear or the hesitation, because until and unless you learn that it's not a scary monster, it's going to feel like one, and then then it's too late because everybody else is already doing it. And so please just don't be fearful, just be curious. And if you approach it with a curious mindset, that's the way to win in capitalism. Yeah,
very, very good point there. Other podcasts, man, I only know of the Chrisman Commentary Daily Mortgage News, but I
must have misspoke, man.
No, I'm kidding. You're good. I always appreciate the time, so I'm sure we'll have you back on the show at some point. It's a pleasure speaking to you, so thank you very much.
Hey, man, I'm honored and looking forward to it.
Today's calendar kicked off with July PPI, which came up 0.9% versus 0.1% expectations, so much higher. We've also received weekly jobless claims in at 224,000, about as expected. Later today brings a flurry of Treasury activity that will be headlined by auctions of $16 billion of 20-year bonds and $8 billion of reopened 30-year tips, Freddie Mac's primary mortgage market survey, and remarks from Richmond Fed President Barkin. After strong producer price numbers, we begin Thursday with agency MBS prices roughly unchanged from Wednesday's close, the 2-year yielding 3.71 and the 10-year yielding 4.24 after closing yesterday at the same level. Let's wrap up with a riddle and some housekeeping. Being a capital markets guy, I'm okay with numbers. Try this. An old man dies and leaves his 3 sons 17 horses and these amounts. Half to the oldest son, 1/3 to the next oldest, and 1/9 to the youngest. How do they divide the odd number of horses? They couldn't cut a horse in half. The answer is to solve the problem. They borrowed a horse from the neighbor, making 18 horses. Half equals 9 horses, 1/3 equals 6 horses, and 1/9 equals 2 horses. That adds up to 17 horses, so they returned the neighbor's horse.
Thanks again to ICE for sponsoring today's podcast. By seamlessly integrating best-in-class solutions, ICE optimizes every stage of the loan life cycle, setting the standard for innovation, artificial intelligence, efficiency, and scalability, and defining the future of homeownership.